Oh, wow. I have some serious technology gremlins this Oh, last week I had no internet. This week the camera wasn't working. Okay. And the phone rings. All right. All right. Well, guys, welcome. I appear to be live. So welcome to the Construction CPA's Coffee Cafe, which seems to have technological challenges every week. Oh, okay. Yeah. All right. We appear to be working. Okay. So welcome. I'm Lisa Raish. The Construction CPA. Here we're dropping the hammer on cash flow problems for contractors with outsourced accounting so you can build things that matter. And today's topic is effective income tax planning and preparation. So we're just towards, we're getting towards the end of the year. So this is a good time for you to start to put together, start to put your stuff together for year end. You don't necessarily want to wait for December 31 to do it or the beginning of January. So now's really a good time. So now is really a good time for you to start to do some planning. You could potentially reduce your tax burden, maybe get yourself a larger refund, or maybe owe less. We work with a lot of businesses, so our businesses tend to owe money. So, could you potentially owe less money? Are there potential tax benefits out there, or credits or deductions that you could be potentially eligible for? Now's the time to start to explore them. Some of the tax options, some of the tax saving strategies that are available to you, you have to have in place prior to the close of the year. So if there's something that you're going to need to put in place, say, for instance, a retirement, you need to have that in place prior to the close of the year. You may not have to fund it, but you would have to have it in place. So now's a good time for you to kind of sit back and start to do some planning. So again, we're going to talk a little bit about income tax. And okay, I was live. Am I live? My video has ended. Okay. So I'm talking to myself, I think. Oh, no. Oh, God. I'm just going to keep talking. And if I'm talking to myself, well, then I'm talking to myself for the next 10 minutes. So, okay. So we're going to talk about income tax here. We're not going to really talk about sales tax or property tax. This is more for income tax. So we've talked about income tax before, but there are different income tax brackets. There's a 10% bracket, a 12%, a 22, a 24, a 32, a 35, and 37. So we tend to work with business owners. Our business owners typically are in that 24, upwards of the 35 and 37%. So we are looking, many of them do have larger balances due. So we are looking to get them some sort of tax savings. So kind of break down some basics. So a tax deduction is an amount that you can deduct against your taxable income, right? And that will just lower your adjusted gross income that your tax will be calculated on. So again, it's a deduction to bring your taxable income down. A tax credit is going to be kind of that dollar for dollar credit that you can apply against your actual calculated tax. So sometimes people use the term deduction and credit kind of interchangeably, and they really aren't the same thing. They are very different things. And then you will have some people who may be exempt from income tax completely. And that's where you would get your not-for-profit entities, right? A lot of the charities that we're familiar with, they're exempt from tax. So like anything else, you want to do your planning and you need to be and want to be organized, right? So you want to have organized business records. You want to have your records up to date. We've talked about we've talked about things like QuickBooks before. If you are using QuickBooks, you're using FreshBooks. Again, there are a number of different accounting systems. You want them to be up to date. You want your financial statements to be up to date so that you can, again, if there are tax saving opportunities out there, you want to be able to calculate something as accurate as possible so that, that roughly what you would have in tax so that you're not guessing like, oh, I think I was profitable this year. So, and, you want to keep that up to date. So you want to keep it organized in however fashion you are, whatever works for you. We tend to be paperless. Everything we have is in electronic format. We keep our files electronically. We don't have paper. Some people still like a paper folder. If paper works for you, then do what works for you. Just keep in mind with paper, you want to make sure that you have some other backup of that paper, because over time, the paper actually does tend to fade. And so while you may have an actual receipt from somewhere, today it looks great. And 3 years from now, it may be faded or almost completely gone, depending on the kind of ink and the paper that it was. So we recommend electronically. We use a product with our clients called Dext that keeps track of the receipts. It's not the only product on the market. It just happens to be the product that we use. There are other products like HubDoc out there. They all do the same basic thing. They keep track of your receipts for you and help you keep them in an electronic format. We also keep some of them in actual electronic folders as well, so that we do have them in 2 different places, just in case, we were to have some sort of issue with losing. Again, you want to have a backup of the backup, right? Again, with electronic is wonderful. You just want to make sure you have a backup of that, or, a way to back it up so that you have more, you don't rely just upon that one item. So again, common tax deduction. So when we're talking about your individual tax return, we're talking about your mortgage interest, your real estate taxes, potentially your medical expenses. If you're a business, it's going to be your rent. It's going to be payroll taxes. Those are going to be, common. Those are going to be your deductions against your income. If you are in a business, there may be tax credits available to you. There may be research and development credits available to you as a business. There are energy credits available to businesses as well as individuals. So when you're an individual, there are child tax credits. That's been a big conversation over the last couple of years, is the child tax credits, right? Those are dollar for dollar credits against the tax that you owe. And again, you need to and want to think about leveraging both of them, both your deductions and your credits, in order to kind of maximize your overall savings. So tax planning really should be done, if you're a business, should honestly be done all year round. It becomes part of your overall business planning. So you don't do your tax planning in January for the prior year, because your only plan in January for tax planning is actually planning to pay your taxes, because that's really all that you have as an option. So as you're building out your business plan and you're looking at what you're trying to do in your business, if you're looking to grow, you're looking to add people, so on, you want to know those things so that you can get ahead of any potential deductions or tax credits. For instance, again, we work with construction a lot. So one of the items that tends to be kind of a lever that we pull for clients is, do they need new equipment? Do they need to purchase new equipment? Do they need that equipment this year? Do they need it next year? Where will we get the biggest benefit, kind of the bang from the buck, out of that deduction, taking, potentially getting to depreciate that asset significantly? Do we want it this year? Do we want it next year? That isn't just, I'm going to go out and buy a truck on December 27th. It's, what do we need? Do we need it earlier in the year? Do you really need it? Do we need it this year? Can we get it next year? Again, that goes into overall planning. It's not something that is just you dropped on your lap on the 27th of, at the December. It's something that is planned out in advance. For instance, if you are also growing and you're looking to, now you're moving from having contractors supporting your business to having employees. So there's going to be the deductions for payroll taxes, depending on the type of business that you have. Maybe your employees are going to expect things like benefits. They're going to expect possibly healthcare, retirement. There are credits to the business related to getting a retirement plan started in the first year. There's also the benefit to your employees, where they could potentially have tax savings by contributing to the retirement. So it becomes kind of a win-win. You're offering a benefit to your employees, but then it's also a benefit to you to potentially bring your your taxable income down. And then also, if you are in the type of entity, for instance, if you're in a corp, an S corp, C corp, you may be, as the owner, partaking in that retirement. So it's a benefit to you as well. So those are all things that you're thinking about as you're moving through the year. This isn't just something that you decide to do again on December 27th. You're planning throughout the year where you can bring these items into your business and where you can really benefit from them. We're in the process, we're getting ready to do like kind of Q3 reviews with clients. So one of the things that we've been talking about through the year, but we start to have a kind of a more becomes more of the conversation is kind of where do we think they're going to fall at year end? So we're working with clients all year round. So if you are in a business and you don't talk to your accountant until tax time, maybe you should be having a conversation with them, throughout the year to kind of see where you're going to fall, where your opportunities are, where you can kind of get ahead of things. Again, it's harder. There's really limited options at tax time to kind of go back and make changes to the prior year. So we always recommend, especially with businesses, that businesses engage with a tax professional, someone to support them through the process so that they can benefit from the, as many deductions and credits as possible. When you are a single individual, you have a tax return with, a couple of W-2s, mortgage interest, real estate taxes on it. It, in many cases, is something that probably can be done by an educated individual who can follow the prompts on the various tax softwares. But when you get into a business, you start to have investments, maybe rental properties, you have a business, or you're more actively engaging on the market with a brokerage account, you really want to think about getting some advice from a tax professional instead of doing it yourself. Again, you might be missing out on tax deductions or credits that you're not aware of, but you would only be aware of if you were actually working with a tax professional. So selecting a CPA, start with friends and family. Who are your friends and family using? Are they happy with them? Do they have a relationship where they talk to them a couple of times a year? If they do, that's typically a great place to start. Interview your CPA just like you would anyone else that, any other professional that you'd want to work with. Kind of be ready to ask some questions about, how they operate and how they work with their clients. You want it to be an open relationship where, you can schedule time with them throughout the year, work on your tax savings, doing your planning throughout the year again, instead of just scrambling to talk to them in December. And I am hoping that we are still on. I did what I said I was going to do, which was to talk until I was basically done with the topic. And I hope this actually did record and that you're actually able to see it. I always look forward to seeing you guys every Friday morning. So if you have any questions about today's topic, any kind of tax planning or tax savings options, please drop your questions in the chat. We'd love to answer them for you. We look forward to seeing you every Friday morning here at 10 a.m. for the Construction CPA's Coffee Cafe. So if we're still going, I'm wishing you a wonderful weekend and we'll see you next week. Have a great day.